Mike Mayo, Wells Fargo head of U.S. large cap banks research, has an outperform rating on Goldman Sachs. And I should point out, last time I gave you a lot of shade for not bringing props. You did not disappoint this time, however.
Yes, it's JPMorgan and Goldman Sachs. But JPMorgan's investor day was yesterday. So what we say is, JPMorgan, take three.
And what does that mean?
It means before JPMorgan bought Bank One, it was a hodgepodge of companies called money center banks. And then you had JPMorgan and Bank One join together, made it through the financial crisis better than the average bank. But now you're at take three, and that means the benefits of scale like you've never seen it before. So JPMorgan, if they had one message, it was like, we are JPMorgan, hear us roar. I mean, JPMorgan is expanding with branches and bankers and bots and in new markets. And Jamie Dimon, the CEO, said, basically, we will defend our turf. If there's an upstart, if there's a fintech competitor, if there's a smaller bank that wants to compete, and we need to preserve the value of our franchise, we'll spend $1 billion, we'll spend $5 billion, we'll spend whatever it takes. And the reason, I think, is because they can afford to do so. JPMorgan is benefiting from scale more than ever before. And that's similar to many large banks in the U.S. banking industry.
Staying on JPMorgan for a second, Bloomberg Intelligence had a note out that said we don't have a Powell put or a Fed put, so any other big catalyst has to come from regulatory relief, helping to unleash some money for buybacks, for dividends, for loan growth. Do you see it as that kind of trade-off?
No. Look, the three R's, rates, revenues, and regulation, which you mentioned, are very important, and that's what most of the discussion is about. What we see for the U.S. banking industry is a 25-year structural breakout for the benefits of scale. So it comes down to something as simple as revenues growing faster than expenses for the next 3 years. And while JPMorgan stock is at an all-time high, we still think it can go higher. Why? Because earnings should grow 50% over the next 3 years. So wow. JPMorgan stock price is anchored to earnings, just like for any stock. And so we still see better times ahead for JPMorgan.
Well, what about Goldman? Because there was a great piece in the Wall Street Journal today talking about lending growth and consumer lending and how much they're putting behind that and the potential opportunity. But they are way late to this party.
Welcome to consumer lending, Goldman Sachs. We would describe that as, from caviar to cheeseburgers. I mean, Goldman Sachs, the advisor to billionaires and multinational corporations, now going to the person on the street. And this is in contrast to JPMorgan or Bank America, where consumer lending is a core competency. Right. So we're watching this Goldman Sachs expansion very closely. Having said that, we give Goldman Sachs zero credit in earnings for this expansion with the consumer lending. Even with giving them zero credit, our expectations are that Goldman Sachs will still exceed earnings expectations because of its core business of capital markets, investment banking, advising large corporations.
Well, I love that you mentioned that, because when I talk to guys over at Goldman, I'm saying, look, your fees on this is going to be like nothing. So can you really make up the volume in terms of fees? And the answer is yes, it can be incremental builder, and 1%, 2% growth can, for them, starting a low base, be huge.
Yeah, it waits to be seen what happens with Goldman Sachs and the consumer lending effort. They've been kind of quiet to investors about it. Right now, it's a hodgepodge of different consumer-facing businesses. They've yet to define to us how these are all going to link together. But they're planting seeds for future growth. If these seeds, go into huge trees down the road, great. If they don't, it'll be considered research and development.
Favorite bank?
Citigroup has come the farthest from the crisis and still has the farthest to go, because we think their returns go up more than anyone else, and they should have the biggest structural risk reduction of any large bank.